Good morning and welcome to this Wednesday, August 17th, 2022 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, we got retail sales out this morning, and honestly, it was just a big yawn. The expectation was for a rise of 0.1%. We were flat. So July retail sales were flat. We strip out vehicles and retail sales rose 0.4%. That was better than the expected minus 0.1% that Wall Street analysts were looking for. But perhaps that could maybe continue a little bit, the inflation narrative. That you've still got the demand out there. But that's coming off of a retail sales report from June, which was twice that size when we strip out the vehicles. So, and it was much slower than the headline retail sales number. So anyway, that's where we are right now. The market did sell off a little bit on Tuesday. We're going to talk about that in just a minute. It did sell off a little bit in the morning, but then came roaring back later in the day. Again, this bull market, when you look at bear markets, they're a different breed. When you're coming out of a bear market, when you hit a bottom, that rally can be extremely powerful. I've written about that. I put tables in some of my articles. I've talked about it on my shows. But when you get that first 1 year rally, even a 6-month rally from the lows, those who don't believe miss the biggest part of the rally. We've gone up. S&P 500 and NASDAQ both up over 20%. I think the NASDAQ was up like 25% off that June bottom. That's a lot. That's, 2.5 years worth of normal returns in 2 months. And there's a lot of folks that just do not believe that this can be happening. And it's frustrating, I know, because when the market goes up, just trying to get the thing to pull back a little bit has been incredibly difficult. So you've got to understand that, we're in a little different era. And now a lot of the folks who said, well, this is just a bear market rally, now are saying we're overbought. So you can't buy now because we're overbought. And it's that excuse after excuse. You look overhead, you look at resistance levels, and you're like, well, now we got this resistance level. Now we got this moving average. Now we got this. I can't buy. In the meantime, the stock market just keeps going up, up, up. Why? Because you run out of sellers. Those who are short, those who have, dug their heels in, they got their money invested. They've shorted. So when the market finally starts to turn and go back to the upside, and you've got Wall Street buying, there's not enough retail traders to bring the market down. That's one of the problems, that we're facing here. Anyhow, a lot to talk about today. Let me go ahead, and for those of you who are new to EarningsBeats, I always like to start off, never know who's new to the show, but first of all, welcome. And those of you who've been coming in and following me personally or EarningsBeats, I want to thank you all so much. It's been certainly a great run. I used to work full time over at Stock Charts. We had EarningsBeats going, and then I went over to Stock Charts. I think it was in 2015. I think it was September of 2015. And then in 2019, I decided to come back. I wanted to do some things. I had started doing some things on my own in my own trading. It kind of really had some of the best trading of my life from 2015 to 2019. And I think part of that was just spending so much time reading and writing at Stock Charts and learning more and more and more about the market. But in 2019, I decided, okay, I can still do my writing over at Stock Charts, but coming back to EarningsBeats, setting up chart lists, sharing them with members. And that was the way I wanted to go with this business. So back in 2019, it was over the summer, I think in 2019, ended up coming back as chief market strategist at EarningsBeats. Brought my daughter in, Erin Weber, who many of you know. She does a fantastic job. Matt Townsend helps me a lot on the research. Of course, my partner, John Hopkins, who kind of kept the ship going while I was at Stock Charts. We've had a great relationship for many years. And John's son, Chris, came on board with us in the last year. He's been on board with us since the very beginning back in 2004, but he came on full time last year, and he does a lot of things that you probably see when you go on the website, but nothing that stands out. You're not going to hear his voice, but he is absolutely brilliant. And so we've got this great team that I've been able to work with now for the last few years. And so I'm the one that comes out here on the shows, and you might think, okay, this is Tom Bowley, but trust me, there's a lot of folks behind me and that are working with me that help make all these things happen. So I just want to thank everybody for your support over the years. It really means a lot to all of us. One thing that we do, even though we do have a paid service, which we'd love for you to try, we have a no cost trial, 30 days. This would be a great time to come in and join us to see what's going on at EarningsBeats. We have so many, so many chart lists and so much research that we do. But it's not just about the research. We give great guidance. I'm going to go out on a limb and say, I don't think there's anybody out there that's given better guidance than us since this pandemic started. 2020, I think we've walked everyone through this whole thing pretty well, considering how new it was to everybody. But, we do we have the market guidance, we have the research, and of course the education that comes through these shows, all of our webinars. And I just mentioned that because on our homepage, you can see research, education, and guidance. Those are our 3 pillars. And when it comes to education, we do free education pretty often. I mean, these shows, the articles I write at Stock Charts, the EB Digest, and then from time to time, we have these free events. I'm not sure we've had a bigger one than the one coming up on August 27th, because everybody's so confused about everything that's going on in the market right now. You look at all the headline news and it's so bad. And of course, everybody's politically motivated, so they're picking sides there. And then you've got the stock market that all of a sudden out of nowhere in the last 2 months is screaming higher, like, we're living in Nirvana. And folks can't, you can't put the two together. They don't make sense. Stock market never makes sense. Hardly ever. It seems like exactly what you think should happen in the stock market, the opposite happens. And it's just the way the market operates. Market's always looking ahead. It's not looking at the news you're looking at. Stock market is looking at what's going to happen down the road. And Wall Street doesn't come in and tell us that, back in mid-June, money was rotating. I mean, if you watch the charts, you can see it. Money is rotating out of defensive areas and into aggressive areas. But you can't see it on CNBC. Nobody talks about it. I haven't heard any stories about analysts going on in mid-June and collectively saying, you know what, we think these are great prices. We're getting in. We think, everyone should be getting in. You don't hear that. Their analysts are doing whatever it is those financial firms want them to do. Anyway, if you want the truth, you got to follow the charts. So Saturday, August 27th, 10 a.m., it's going to be a free event. It's going to be very similar to the Market Vision events I've done the last 3 years. And if you've been to any of those 3, you know that the market calls that I've made have been pretty good. And I'm being kind to myself. They've been really good. This year was unbelievably good. On Saturday, August 27th, I'm going to take a look ahead to what I see based on the charts. I'm not going to sugarcoat it. If things change between now and the 27th and we start rolling over and things are ugly, I'll tell you they're ugly. If we continue to go higher and the trend looks good and I'm seeing no problems, I'm going to say full speed ahead. And if we're consolidating and market is starting to look mixed heading into September, which can be a rough month, I'm going to talk about that. I'm going to talk about whatever it is I'm seeing on the charts. Anyway, you need to be there. Saturday, August 27th, 10 a.m. Click on this to register. Read more about it. You can read more about some of the predictions that I've made the last 3 years. Check it out. You'll do yourself a favor there. All right, looking at what happened yesterday. You look at the charts and you think, wow, nothing changed. Dow Jones up 239. S&P was up 8, so a little bit lesser. NASDAQ was down 25, so we did have a little bifurcated action. Mid caps up another 0.6%, 16 points. Small caps up 0.4%, 5 points. Except for the NASDAQ, new highs, continuing to move higher and higher. AD lines keep going up. You look at sectors, staples lead. That's kind of strange. Discretionary right there with them. Neck and neck. The two consumer areas. Everyone's talking about the slowdown, the economy, recession, flat retail sales this morning. Wall Street's buying consumer stocks. That makes no sense in a recession or recessionary environment. We've got 2 straight negative GDP readings. For many, many years, that was the definition of a recession. Now, the government wants to look and see, and well, let us decide. We'll tell you whether it's a recession or not. That's great. I mean, you call it what you want, but 2 quarters of negative GDP growth, to me, that's a recession. That, to me, again, okay, maybe we don't call it a recession. How about a weak economy? I mean, we call it whatever we want. It's still not good. And yet, with 2 straight quarters of negative GDP, which, by the way, GDP is comprised of 2/3 consumer spending. So when you see consumer stocks rising, I mean, there's nothing stronger right now in the market than consumer discretionary stocks, which would be the last thing you would want to buy in a recession, you would think. A recession means things are contracting. People aren't going to spend as much. They're not spending as much. Discretionary is exactly what you would buy if you're feeling good about things and you're spending money. Makes no sense. Again, stock market never makes any sense. Follow the charts. Consumer stocks are leading right now. That's because Wall Street is looking ahead to the end of the year, maybe even into the beginning of 2023, and it likes what it sees about the economy then. It doesn't care about this morning's retail sales report. That's for gap ups and gap downs and manipulation and all that. It has nothing to do with what Wall Street sees 6 months from now. Then you've got financials leading. Financials have been doing better. You can see really nice uptrend. Last 5-6 trading days especially. We've been trending higher since the double bottom in July, but really starting to accelerate now. Materials up more than 0.5%. I think materials, you can look at materials, look at the June high. We're way below the June high. Look at every other one of these sectors. We've easily cleared the June high. So on a relative basis, even though materials did well yesterday, materials are still struggling. But in a bull market, a rising tide lifts all boats. Materials trading above the 20, which is now above the 50. It's just that on a relative basis, and I'll show you this in a bit, on a relative basis, it's still struggling. There's real estate. Real estate looks really good here. Look at that. Move up, trading above the 20-day moving average. PPO great. Even the AD line starting to strengthen some, although it's probably the weakest among the sectors, or about the weakest. But price action, I mean, everything looks good. I'll go through and I'll show you all the sector relative charts in a little bit. And you'll see real estate's doing nothing on a relative basis. So yeah, everything looks good on an absolute basis, but that's why you need to look at relative strength to find the true leaders. 10-year Treasury yield with that flat retail sales report. Get an update here. Right now, 288. We're up 6 basis points on the 10-year Treasury yield. That's kind of weird. I would not have expected that with a flat retail sales. If I had looked only at the 10-year Treasury yield and I hadn't seen the retail sales report, I would have thought, okay, definitely would beat expectations. Retail sales probably came in up 0.5% or something. And, that must be why the Treasury yield's going up. Treasury yield's just in a kind of a sideways consolidation pattern at this point. We keep going up above the 20-day, below the 20-day, above the 20, below, back above the 20. That, to me, just reeks of sideways consolidation. We're not trending below the 20-day anymore, and we can't seem to hold it and sustain it when we get above it. When you see that kind of action around moving averages, that's the definition of sideways consolidation. So until we start making new highs, get through the 50, come back, test the 20, bounce off of it, go back to new highs. I would say right now the yield's not trending higher. The overall intermediate term is lower, but I would just say the short term is more sideways. Not really giving us any clues there. But we are way off that 348 high, 3.48% high from back in June. So that's good news. Certainly for many of the growth stocks. People have asked me, okay, well, what will it take for you to decide that this is just a bear market rally? Well, we've only seen a bear market rally anything close to this 3 times in our history. 1974, 2003, or 2002, 2008. Those are the only 3 times we've ever been in a bear market, had this kind of rally and stayed in a bear market. So it doesn't happen very often. So you're really facing some stiff odds if you believe that we're going back down. And notice I didn't say it's 100% guarantee that we're not going back down. There's always a chance. You got to at least have a mindset that says, I could be wrong. Even though I'm as bullish as they get, I could be wrong. So what would change this for me? Well, obviously, first off, we're going to have to trade below the 20-day moving average. We haven't even tested it in the last 3 weeks. I mean, off of this test back at the end of July, it has been straight up. And this is how most bear market rally, or not bear market rallies, most bear market bottoms, this is how we normally come out of bear market bottoms in starting a new bull market leg to the upside. This is how many of them begin. Like they will not stop. I don't know, when or if we're going to take out that 20-day moving average. What I suspect is we're probably going to come down at some point and have one more test. It would certainly make sense to do it now with options expiring and so many in the money call options out there. It would help market makers. Volume hasn't been incredibly strong, which is what everyone points to. Oh, it's bear market rally because volume's low. Who's panicking to buy stocks? You panic when you sell. You don't panic to buy. Volume always goes down in the middle of a run to the upside. I mean, study the market. Anybody who says volume's light and therefore this rally is unsustainable has not studied the stock market, because this happens all the time and stocks keep going higher in bull markets. So don't pay attention to the volume argument. What I would be concerned about right now, I think we have pretty good price support down around 41.50, 41.7. Actually, that high was 41.76. So that would be a support level to watch, the first one. We've got gap support right here, just above 4,100. We got the 20-day moving average at 41.28. All of that, to me, is the first primary level of support. Now, if we lose it, am I going to be rushing for the exits and screaming bear market has returned? Probably not. I mean, I'll acknowledge that would be a big initial breakdown. There's no doubt. But that wouldn't necessarily paint the picture to me. I think the psychological level down at 4,000 for me, if we break 4,000 and it's in the month of September, I wouldn't be able to write off that there's an increasing chance at that point that we would see a double bottom. September scares me. I study history. I know what September is all about. It's the only month that the S&P 500 has gone down more than it's gone up. Last 72 years, the S&P's gone down in September 39 times. It's gone up 33 times. The only calendar month to go down more often than it goes up. Many bottoms form in September, October timeframe. Many big bottoms. So I'm not oblivious to the fact that September can be a rough month. But I'm also not going, that is kind of a secondary consideration. Why is it secondary? Well, 33 times September's gone higher, almost half the time. And we're in a raging bull market right now. Call it a bear market rally if you want. I think we've started the secular bull market has resumed off of this low. The bull market that we've enjoyed since we broke out in 2013 above the 2000 and 2007 S&P 500 highs, right around that 1550, 1575 area. We did that on April 10th, 2013, and we haven't looked back. We've had weakness like we saw in 2015, 2016. We saw a bear market, 2018, cyclical bear market. We saw the cyclical bear market, the pandemic of 2020. Everybody wanted to call that the Great Depression 2.0. That lasted a whopping 28 days or whatever it was. And now we've had this one. I look at them all as cyclical bear markets in a secular bull market. Short-term pullbacks in a long-term, but it's not a typical pullback. A typical pullback is like what we had last September. There's a typical pullback. And then you go to new highs. This isn't really a typical pullback. This is a cyclical bear market. They don't happen very often. We've only had 11 cyclical bear markets since 1950. We've had a bunch of these pullbacks. Not too many of these. So knowing the history of those and how we come out of them is kind of an important thing. This looks a lot like many of the others to me, where we just don't even get a 20-day test. We just keep going up, up, up. There's a lot of money on the line this week for market makers, which is why I'm probably the most defensive right now that I've been since mid-June. My trading account does not have a single long position right now. And it's not because I don't think we're in a bull market or I don't think we're going higher. It's that I'm a short-term trader and there's just too much risk in the market right now. It comes down to me. I don't care if I'm right about the market pulling back with option expiration week. To me, it's about just the fact there's too much risk. So I don't care if the market keeps going up, great. For those of you, and I think long-term, you should be in the market. Shouldn't be worried about this week's option expiration and a pullback that we might get. If you're a long-term investor, I would be in, and I wouldn't be thinking about getting out. If I got back in at that June low, just get in, just hold. That would be my suggestion. I'm not a registered investment advisor. I don't give advice. I don't give recommendations. I'm not licensed to do that. I educate. Talked about why I like the bottom right there in June. I think since then, all of our sustainability ratios have been strong. I think we're going higher. Short term, though, definitely could go lower. So here's a 10-day, 10-minute chart. And one of the things that I was looking at, there was actually a little bit of technical crack in the foundation yesterday. And I pointed this out in the newsletter to the members. And I actually provided a chart a couple of days. And I was kind of watching this right here. So this was kind of when we saw the market really start to accelerate to the upside. And when we came down at the end of the day on the 11th, which was Thursday of last week, it looked pretty bad. I mean, that was a big reversal. And then all of a sudden we took off again. Well, if I take that low and then the low from that Thursday close, and I draw this line, I was kind of watching this as a potential trend line. And early yesterday, when we saw the first real weakness of the last couple of days, we saw it go back below this trend line. We kind of came up, tested the trend line, and we've stayed below it. And now all of a sudden, we're, I'm going to add some bars here. So now all of a sudden, we've got the futures down. Let me see where the futures are. I didn't even tell you what the futures were doing. My bad. Well, one thing we can do, you just go over here. I mean, market's going to open here in about 7 minutes. So the diamonds are down 0.6% right now. The spider is down 0.8%. And the QQQ is down 0.9%. So looks like we're going to get off to a little bit of a rough start. But again, over the last 2 months, we've seen this plenty of times. We've seen gap downs. And all that's been is a recipe for more buying to come in off the gap downs. And there was a video that I did over at Stock Charts yesterday. If you haven't seen it, you should go see it. Just if you type in, if you go to YouTube and just search Wall Street Thieves, I'm sure it'll come up because that was in my title. But I did a special presentation showing the manipulation of Wall Street during the first 6 months of this year. And it was eye-opening. And I know I I haven't looked probably since midday yesterday, but I know there were some comments coming in. And people were like, my gosh, I've never seen it put out, shown or illustrated this way. Go back and take a look at that if you haven't. It's a 30-minute video, but it'll be well worth the 30 minutes to go back and understand the phases that we went through and how Wall Street manipulates us into selling out when they're buying. It's disgusting. And I know some of you don't like for me to do my CNBC rants and all, but I'm sorry. They need to be called out, because I think that is a platform for this disgusting filth from Wall Street to take place. And they do it at the expense of everybody else. They're clickbait, these horrible headlines. The market's going to go down. We get these big gaps down, and then Wall Street buys the rest of the day. Thank you very much for your shares. Thanks for playing. That's what I feel like Wall Street's saying to everybody as they take our money. You got to learn about how the market works. Anyway, as I looked at this now, what I was trying to do is I was thinking, okay, well, maybe we're going to start a little channel to the downside. So this is just something that I'll be watching to see. Maybe it's something like, maybe it's something like that. And then I just got to kind of extend this without messing up the angle. Something along those lines. Maybe we're going to be down at the open. If we rally, check this trend line out. Now, if it goes right back and goes through yesterday's highs, then you can toss this right out the window. But if we gap down and rally back and we hit this trend line and then go down again, you're going to start to establish a pretty strong overhead resistance channel line. And then what you want to do is drag that channel line down to a recent low. Maybe at some point we'll go down and set another big low and then rally back up again. And if we do, maybe it's the same sloped line. That's what I'll be looking for. All right, let's talk about the sectors. We got 3 minutes before the market opens. I'm going to go through these sectors and then we'll wrap up. So this is a long-term approach to the market, going back the last 5 years. Top part of this chart is technology relative to the S&P 500. And you can see technology usually leads the market higher. And that's true of most periods during a bear market. Not all periods, but most periods. I mean, we go back 10 years to the start of the bear market, April 2013, and you look at this chart. During a secular bull market, I think it's probably smart to be in technology. Now, the slope of this line really turned up during the pandemic in 2020 and then 2021, that final last hurrah. And it took a period of unwinding, I think. I thought that was necessary during the first part of 2022 to lead what I thought would be a cyclical bear market in the first half of 2022. I think, to be fair, I was saying 3 to 6 months back then. So I felt like sometime by March to June is when we would probably bottom, and then we would have a much stronger second half of the year. Well, technology is playing right along. Went down the first 6 months on a relative basis. There's the absolute. I mean, couldn't have been much more than 6 months. I mean, a better call than 6 months. It was 6 months almost exact. Technology struggled, relative strength was down, and now we're rallying back, and we're rallying back up. And I said, as soon as we started to make this rally back, that it was looking to me like previous times where we've been with negative relative PPOs. The only way you get negative relative PPO is if technology on a relative basis is weak for a period of time. These aren't just pullbacks. These are extended periods of time, 6 months or longer in most cases, where technology underperforms. 6 months underperforming of technology in a secular bear or secular bull market, it's very unusual. But there's the rally back through the moving averages. There's the rally back through the moving averages when it was negative. Look at that subsequent move. Here's the rally right here when PPO, relative PPO was negative. Look at what technology did after that. Here was one off the center line. Didn't quite go negative, but we're right on the center line. Look what happened after that. Here we were really weak. This was back in 2013, right before the bear market kicked in. And as we turned back up again and we saw the PPO turn higher, look what that led to. So am I going to ignore that? No. That's one signal, just one, that tells me that we got blue skies ahead. It's just one signal. Consumer discretionary, this is the hottest area in the market right now. Look at what happened last time when we had this really weak relative PPO on the XLY versus the S&P. Look what happened when we came out of it. And this started to turn back up. Look at that strength. Does it look familiar? Certainly looking familiar to me. Communication services. This is the third of the three aggressive sectors that I like to follow. There's really 5 aggressive sectors. The 2 I just showed you: communication services, industrials, and financials. Industrials and financials, when the economy is doing well, they kind of go along for the ride and might see a little leadership out of the industrials. But for the most part, they just kind of go along for the ride. Technology leads, consumer discretionary leads, and normally communication services leads. Now, I'm starting to see some good things out of companies like Disney, Google. Google's been a leader throughout the whole bear market on a relative basis. But there are some leaders that are starting to maybe get things to turn a little bit back to the upside, but there's still a lot that need some work. But maybe that was the final bottom. We'll see on communication services. The final bottom on a relative basis. We actually bottomed in June on an absolute basis, but as we rose, we weren't rising as fast as the S&P. And so we set a new low on a relative basis. That's why moving higher doesn't always mean good things, because on a relative basis, you can still be underperforming. That's why when I look back here at the very opening of the show, and I was saying, well, real estate's looking pretty good, materials looking pretty good. Well, when we look at the sectors, see if I can pull, there we go. So when we look at the relative strength on some of these sectors, they don't look as good. Now I'm going to go much faster. Market's opened. So let's go through industrials. Sorry, there we go. Industrials just recently broke out to a new relative high. Looks good to me. Financials, been going down, but finally started to turn up a little bit. So maybe improving, but got a lot of work to do. Healthcare, all of a sudden, is falling apart. Usually summertime, August tends to be pretty good for healthcare. So I'm a little surprised by, given the historical tendencies that we've struggled in August. Consumer staples, here we go. So consumer staples, it's recently starting to show a little bit of relative strength. But look, during the big rally in July and early August, consumer staples it was going up. Look at it, it's going up, but its relative strength was going down. Rising tide lifts all boats, but it doesn't lift all boats equally. Well, maybe a rising tide does lift all boats, but the stock market rising tide does not lift their boats equally. Real estate. Remember how real estate looked really good on that daily chart I showed you at the beginning? Look at the relative strength. It's just, not really doing anything. Certainly not a leader anymore. Utility still looking okay to me. I'm really surprised. I thought, I thought back in June we had a top, and we do have a top, but we are starting to show some little subtle relative strength. This one kind of watch. I still think we're rolling over. Energy has definitely rolled over since the high at the beginning of June. Not nearly as strong the last 2 months, 3 months. Materials completely fell apart in June, struggling to gain anything on a relative basis. Yes, it's going up. Why? Rising tide lifts all boats. Everything's going up. But is it leading? No, it's not leading. Anyway, those are the sectors. Let's get just a quick look at the market. I'm not going to do any, we got NASDAQ right now down 1%. I'll tell you what I'll do is I'll look at a couple of charts for you that we talked about last night with max pain issues, meaning they've got a ton of in the money call premium. You got to be careful. I love Tesla. I would not touch it right now on the long side. As of the Friday close, Tesla had almost $1 billion of net in the money call premium. Want to be careful when that's the case. And we went up on Monday, by the way. So we probably went well over $1 billion, probably 1.1, 1.2 billion at the high. That tells me market makers, if prices come down, market makers can save a ton on paying out option premium. Option, the value of all the options out there. And sure enough, yesterday we reversed. Today we're already set an intraday low that was lower. Let's look at a 5-minute or 10-minute 5-day chart. So there's your lower low. Here's your little rally. I expect maybe we'll see a little bit of rally and then another drop is what I would expect. Now, of course, with this secular bull market, who knows? Maybe we just go to a new high. Then the other stock that I talked about, and I actually had both Tesla and Enphase Energy in the DMR from Monday. Enphase yesterday came down, and then today it's down right now only 62 cents. But you can see since the top, look at this. And there's your gap down. Here comes your amateur hour. It's coming rallying back. So probably a lot of folks seeing that going to jump on board. Wouldn't be surprised another hour or two if we're back down at the low. Got to be careful. I don't trade the mornings unless it's in my favor. In other words, if I've been waiting to buy Enphase Energy at 20-day moving average, and its 20-day moving average was sitting at 287, and I saw morning weakness and went down to 287, yeah, I would use that weakness to buy. But that's not what we're looking at right now. So anyway, those were two, and then I'll give you one other one. I know that we had talked about, Netflix. Netflix is one I think you got to be really careful of right now. First of all, massive overhead resistance. I wrote about this in the Don't Ignore Your Chart blog, probably a few days ago, maybe the end of last week sometime. And I said, if there was one stock in the market that I would consider shorting, it would be Netflix. And I do have a short position in Netflix right now. Full disclosure, but right around 250, that's where all the massive selling began back in April. We worked our way all the way back up to it. I mean, if you look on a relative basis, Netflix relative to the internet stocks, it's taken a beating. Got a little bit of a relative dead cat bounce, I would say. This is still a very, very weak stock on a relative basis. So I think it's going to head back down 220 area, probably, maybe even lower. Depends on the overall market and how much we actually sell off. But I wouldn't be surprised. And now we're starting to see Netflix weaken. Today, gap's way down, coming back early morning. We'll see what happens, whether or not we sustain that. If we get back up above 245, 246 after this gap down today, I'll be shocked. We could. Anything could happen. But I believe these are just three stocks based on Max Payne that we talked about that could struggle into the end of this week and maybe even into the early part of next week. So that's all I got for you today. Again, let's go take one final look, see where we are, see if we're getting maybe a little bit of a rally back off the initial low. We'll see whether or not this is more of a sustained move to the downside. Options would argue that we're going to have a move to the downside. We'll see. The secular bull market says we take no prisoners, sell at your own risk. You got to figure out where you fall in all of that. Anyway, again, go back and check out that video on YouTube, Wall Street Thieves. Just search and put that in there. I'm sure my video will come up. And then also don't forget about the event. You've got to sign up for this. So you got to register, name and email address. And when you do register, if you're not already on our EarningsBeats Digest newsletter, which is also free, no credit card required, we'll make sure you get added to that as well. Anyhow, everybody have a great day. Happy trading.